In this video we will briefly discuss IAS 2. Inventories. IAS 2 remains the governing standard for inventory accounting under IFRS. Overview of IAS 2. IAS 2 Inventories is an international accounting standard that prescribes the accounting treatment for inventories. Key objective of IAS 2 is to ensures consistent accounting for inventories, defines how to measure inventory cost. It requires inventory to be valued at the lower of cost or net realizable value. Scope of IAS 2. IAS 2 applies to all inventories except work in progress under construction contracts, which covers in IAS 11 or IFRS 15. Financial instruments, IAS 32 and IFRS 9 covers that. Biological assets related to agricultural activity, in IAS 41. Now let's look at IAS 2 key requirements. First one is measurement of inventories. A. Initial recognition. Inventories must be measured at initial cost. B. Subsequent measurement. Lower of cost and net realizable value, NRV. C. Cost includes purchase costs, that is price, import duties, transport etc. Conversion costs, that is direct labor, overheads. Other costs incurred to bring inventories to their present condition and location. If NRV is lower than cost, inventory must be written down and the loss recognized in profit or loss. Second requirement is cost formula. Which costing to use depends on business nature and accounting policies. First one is specific identification. Second is FIFO. Third one is weighted average cost. And last is LIFO, but it is not permitted under IAS 2. GAAP users can still use this method. A little about specific identification method. A cost formula that tracks the actual cost of each individual inventory item, used for unique, high-value items. When to use this method? For customized or distinguishable items, for example, luxury cars, jewelry, real estate. When each item has a significantly different cost. We have already learned about the three methods in previous videos. Third requirement is recognition as an expense. When inventory is sold, its carrying amount is recognized as cost of goods sold. If inventory is lost or damaged, it should be expensed immediately. If NRV increases, reversal of write-downs is allowed. Disclosure requirements. 1. Accounting policies are used, like cost formula. Measurement basis. 2. Carrying amount of inventories, it has to be classified appropriately, for example, raw materials. Finished goods. 3. Amount of inventories recognized as an expense. Cost of sales. 4. Any write-downs or reversals of write-downs. Conclusion. IAS 2 ensures consistency in inventory valuation and prevents overstatement of assets by requiring the lower of cost or NRV. It enhances comparability across financial statements. Key points of IAS 2. 1. Inventories measured at lower of cost or NRV. 2. FIFO. Weighted AVG allowed, LIFO prohibited. 3. Write-downs impact profit or loss. 4. Disclosures ensure transparency. Case study. Suppose a retailer has 100 units of product X. Its cost per unit is 50, but due to market change, the selling price now is 45, and its cost of sale is 5 per unit. Now we must calculate NRV first. So for NRV, subtract cost of sales from selling price, that will be 45 minus 5, so we have 40 as NRV. Since 40 is less 50, it means we must write down our inventory at 40 according to IAS 2. That concludes our today's topic. If you have any question, ask me in the comments section.